Hi there. First of all, don't get confused. I am in an hospital under a treatment, which is serious, but it's going very well. I'm telling you because I won't stop this program, Hedging with Jorge, and because you perhaps may notice a beep, which is my heart beeping over there. So let's dive into our program, Hedging with Jorge. Do you remember that the last time I promised you that we would study the structure of a zero cost collar? This is the name of the strategy for a consumer. Basically, these structures give you the possibility without any cost, because it's a zero cost collar, to be protected in a range of prices. So we have two alternatives: mainly go through futures or go through options. But we have decided to explore go through options because it gives us the possibility to be hedged with a zero cost, in this example, in a wide band of prices. But stop there, because first of all, I need to review with you the concept of buying a call. We have seen that many times, which is the right to buy. You pay a premium, and at the moment of the expiry of the call, you may decide whether to exercise it or whether to abandon it. Okay? That's the concept of buying a call. But remember that at the time of buying a call, you need to decide the strike price, which is the level of your insurance, the level of your protection. So, let's dive now into an example. Look at this. We are presenting a market price for aluminum for the third Wednesday of December of 2,625. That was the prevailing price as of last Friday, which was August the 14th. Okay? The market price was 2,625. When you see the numbers, if you choose the same price as your insurance, as your protection, we are talking about an at-the-money call. And the strike price will be the same as the market for December. In other words, the strike price in this example, when we call it an at-the-money strike, is 2,625. And the cost in this example is $102. Okay? Are you with me? $102. Well, now let's explore the case that we decide not to buy a call with a strike price of 2,025, but to take a little bit of a risk. What does it mean? We would be only protected, in this example, $50 higher, which means that the strike price is 2,000, in this example, 2,675. And look at the cost, it's $80, just $80 for December. So, the difference between buying a call with a lower protection, I mean that we will have the right to buy at 2,675, which is $50 risk on our side, implies a saving of $22 in the premium, because in this case the premium is $80. Okay? And let's see what happens when, instead of choosing 2,625, we want to run eventually a higher risk, which is to be, for this example, a strike of 2,000 2,725. In this particular case, the cost is, of course, much lower, $62. This is the same case when you have an insurance on your car or in your house. If you decide to run through a deductible, which is the protection does not protect 100%, but you run a piece of the risk, the premium is going to be always lower. So remember, in this case, we need to carefully understand what's going on in the three scales of strike price, which I arbitrarily choose. We can choose any other strike price, provided if we trade with the LME with steps of $25 and $25. So an at-the-money strike price means that the strike price is similar to the market value. In our example, 2,625 means the cost 102. If we decide to buy the call with a higher strike price, which means a risk on our own, the cost will be $80. Strike price 2,625. And finally, if the strike price is, in this example, 2,725, which is $100 risk, the cost is just 62. And now, why do I buy a call? Because I have a purchase, say, of ingots to be melted and to produce a secondary alloy, which price is floating, and I want to hedge it. So I want to place a hedge for December. This is the reason why I'm buying a call. So my proposal to you guys is to understand very well what we are talking, because after analyzing the possibility of buying an out-of-the-money call, which is much cheaper, what can I do to finance its cost? Okay, so see you next chapter, See you on our next session of Hedging with Jorge, which is Hedging with me. And hopefully next episode I will be out. Thank you.